Florida.
Thank you very much, Mr. Chairman. I don't want to beat a dead horse, and my dad always told me that you should never ask somebody how much they made. But since somebody already asked that and the door is already open, one question that kind of begs for an answer is the answer or the question of what your compensation was before the train wreck. Not necessarily last year, but what it was the year before. We could just start at one end, just real quick. Salary and bonuses for 2007.
In 07, $600,000 of salary and something like $67 million worth of shares and some cash.
Okay.
At the values that pertained in 2007, which wouldn't look familiar to you now.
Right, for the year 07, $1 million of salary, $29 million of cash and stock. Again, the stock is not worth what it was then.
Okay.
And Congressman, in 2007, it would have been $1 million salary, and with all the long-term option type compensation in total, it was around $20 million.
And you said 2007.
Yes, sir.
2007 would have been about $14 million, all inclusive, including stock and cash.
Congressman, I believe it was $1 million in salary and total compensation of about $20,500,000, if my memory serves me well.
Compensation was $800,000 and zero bonus.
$250,000 in salary and $2.5 million in stock.
At $800,000 in salary, $4.2 million in cash bonus, and $3 million in stock in option value, which today, of course, is worthless.
I think that might help give us a little bit more insight into the train wreck. Mr. Diamond, there's some arguments on both sides about this cram down. Can you tell me the effect the cram down would have on your institution?
Let me just start by saying we are deeply in favor of having solutions for more modifications. We've done 300,000 already. We expect to do 650,000.
That's the next question. But right now,
No, but
if there was an arbitrary cram down, if a judge could reduce the amount,
we believe that an arbitrary cram down would greatly increase the cost of mortgage losses, and that it would also increase the cost of all unsecured credit, as you gave an incentive for people to declare bankruptcy.
okay, does anyone besides Mr. Pandit disagree with that? I mean, it's logical. It makes sense to me. The next thing is, I gave an example when we were talking to the Treasury about some constituents. They have about a $400,000 loan on a house that's now worth about $250,000. They lost their jobs, couldn't make a couple payments, got behind, started a little business, or able to catch up, and their company, and at the time I didn't want to mention it because it would be indiscreet, but it's countrywide, refused to accept any payments unless they got caught up in full. So, their CPA advised them, give the doggone house back and go buy a short sale down the street. You'll be $150,000 better off. I understand that perhaps whoever's servicing the countrywide paper may be concerned about some liability, and that's the only possible excuse for not using the good judgment of trying to mitigate such a stupid, horrendous, upside-down loss. Would the ability to have servicers modify mortgages without liability be appealing, and do you think that would lead us toward a solution to this foreclosure crisis? And we can start at the end with Mr. Blankenfein.
I think doing something about the liability would be helpful. We are modifying these mortgages without that protection now, and so we would welcome the protection.
Is it your own loans or loans that you might service?
If it was our own loans, we wouldn't be worried about it at all. It's other people's loans that we're servicing.
And you are modifying loans that you service now then?
Yes, we are. And reducing principal, because we think that's the best way of recovering value, that people tend to stay in houses and support their payments when they have equity. And so we believe we're carrying out our duty to our investors if we, in fact, cut principal down and keep people in their homes and let them have positive equity in their homes.
Mr. Lewis, Mr. Lewis, are you, let's see, 1, 2, 3. You're Mr. Countrywide? Mr. Bank of America? No, you
No,
are.
I'm not Mr. Countrywide. But we're being very aggressive in doing modifications with loans that we service. We have changed the policies at Countrywide, but it would help if we got some help on that issue.
But you have already changed the policy?
have
Like,
changed.
like these people should be getting some kind of response rather than walking away, or?
I can't imagine we would do that under our policies, because that would be a perfect loan modification situation.
It's a no-brainer. Maybe I can get my staff to get one of your cards or something, and they could contact you
would.
directly to
Actually
see that
would.
gets taken care of. Mr. Diamond? Out of time? Well,
Time has
Thank you
expired.
very much for your indulgence, gentlemen.
Mr. Miller.